Okay, guys. Welcome to the Williams channel. Welcome to the Williams channel. Yeah, I know most of us are had it a little bit pushed up to want to learn forex. Forex is not difficult. It's not difficult. There are people, those that I have trained before. I've told them before that if you are a student and your pocket money is 100,000 naira, then you can do forex because you can easily make 100,000 naira in a month. That would be about $15 a day. Very achievable, which is very, very achievable if you know what you are doing. If you take time to learn it well, forex is not difficult in any way. And right now, we're just going to briefly talk about candlesticks in this video, and we'll move into other videos. Okay, I want you to take your time to listen to this video well, watch this video and watch other videos. I think this will be the second video I'm making in this series, and I need to say this since I didn't say it in the first video. Watch every of these videos. Come back with your questions. I am here to answer them for you. At least with the little experience I have gotten, I can answer your questions on forex. With the little profits and proven methods I have had, I can show you what I have done. Don't let anybody deceive you with coming to pay for strategy. No. You can only pay for, if somebody says buy my indicator, that will help you out in analyzing. Well, if you feel you need it, you can buy it. But there is no such thing as an 100% indicator. I must say that there is no such thing as 100%. There is nothing like that. Even that professionals give, there is no such thing as 100% signal. It's the truth. No such, because nobody created the market. The market is being moved by different forces. Fundamental news, the banks, big institutions, the government, and then retail traders like me and you. So imagine if 10 million retail traders are buying Euro USD, are placing a buy on Euro USD. It will definitely push that market. So nobody can drop a signal and say it's 100%. No. Everybody's signal can be like 80-85%, but none is 100%. And if you stick by your rules and discipline, wins, you have losses. But at the end of the day, when you are calculating your profits in total, you realize that your profit is more than your losses, and you can be going home with at least 100K if you are a conservative trader. You can be going home with between 70 to 100K a month, which is very fine for you. And if you feel okay, you want to push more and grow, then increase your capital. Throw in $2,000 into the market. Throw in $2,000 into the market and start trading. Believe you me, you'll be going home with more than that. You'll be going home with more than $500 a month. That $500 a month is the meaning, because that $500 you can do it in 2 days. You can do it in 3 days. You can even double your account in a day. And it's the truth. You can have a $2,000 account and double it that same day. It's just the truth. So at this point, we are able to look at the candlestick trading. We're able to look at the candlestick trading Bible and would look at it together. I'm just going to talk about the candlesticks, the basic candlesticks that we have in the market. And I will show you some of them in the market, how they are. So we are doing them one by one. We are going to check how they work in the market. I'm just going to show you some. Take it to time, but I've not looked at this, so I may be looking for the candles in the market. Okay, so let's go. The history of candlesticks, we must start from there. Sticks have been around a lot longer than anything similar in the Western world. The Japanese were looking at charts as far back as 17th century, whereas the earliest known charts in the US appeared in the late 19th century. Rice trading had been established in Japan in 1654 with gold, silver, and rapeseed oil soon after. Markets dominated Japan at that time, and the commodity became, it seems, more important than hard currency. Muneisa Homa, Sokyuhoma, a Japanese rice trader born in the early 1700s, is widely credited as being one of the early exponents of tracking price action. He was tracking the different price, the rising price of all these trades. Okay, like, okay, today the price was also at so point. Tomorrow the price possibly was using lines, and then he moved into candlesticks. Okay, the price was at this. The price opened this month. The price opened here. It fell to this point. It got to another, and it closed at this point this month, and it moved to the next month. That was what he was actually tracking as at that time. He wanted to track the emotion of the market players, and this work became the basis of candlesticks. Okay, I'm around here. Became the basis for candlesticks. I'm here. He was extremely well respected, to the promoted to samurai status. And you know the samurais are really respected in Japanese. I'm just going to skip this one. We should know just that's the history of how it started. And then in December 1989 edition of the Futures magazine, Steve Nissen, who was a technical analyst at Merrill Lynch in New York, used a paper that showed a series of candlestick reversal patterns and explained their predictive powers. This was at the time started predicting more what candlesticks can do. Let's just jump into what the candlesticks straight up so we don't waste time. Why candlesticks are important in your trading analysis? If you want to be a price action trader, which I master to candlesticks, there is nothing else. It's flexible. You can use it to analyze anything. If you have just used it your support, good. I personally use candlesticks with support, resistance, trend line, and other technical tools that you discover in the next chapters. Simple. Let me quickly show you one of my charts here. Okay, this is one of my charts that I smashed yesterday. This was in profit. Right from here down to this point, I was in profit. All I drew, let me reduce it to, let me take it to 4-hour candle. All I drew was support. This was resistance, this was resistance. This was first a support, it broke and it became resistance for me. And then I entered my trade. As I saw its test, I entered my trade and I smashed it seriously. I had about 50 pips from here. Okay, I had about 50 pips, and that's a trend line coming here and some support zones. So basically, that is what I just noticed. What did I notice about the candle? They were long red candles. We call them red bearish candles. And then I knew this was my time to enter. Okay, this was my time to enter, and I entered right. Now, if I want to enter this trade again, I wait for investment and then I continue the trade. However, let's go back to where we were, because we'll be coming back here once in a while. I have to pause some of my trades for today for this situation. Candles by professional traders, banks, and hedge funds. These guys trade millions of dollars every day. They can move the market whenever they want. They can take your money easily if you don't understand the game. And if you can trade $100,000 trading account, you can't move the market. Even if you can trade one, you can't control what is going on in the market. So don't come and say, I put $10,000, I went for a buy, and then it's like somebody is monitoring my account and went for a sell. Nobody is monitoring your account. The banks are monitoring everybody's account, actually. They are monitoring what everybody is doing. So if you are part of the unfortunate few that are trading against the bank, you will actually be losing money. In the course of our mentoring sessions, I will teach you how to trade with the banks. It was a book I just got recently, how to trade with banks. When the banks decide to move the market, that is why most of us are profitable. Most times I don't even look for long pips, like 200 pips, 300 pips. No. Once I have 50, 100 pips, I'm out of the market. I just throw in a good lot size. And if I have 2 of that in a day, I've done my target and I've done more. If my target is $200 per day, I have done my $200 that day and I have left the market. Sometimes my target is just $50 per day because as a Nigerian, I want to achieve 500K, 600K in a month. So I know I do more than that lately, yes, but I just want to achieve that and move. But we are still in a process. We are still in a process that must be respected and followed. So using candlestick pattern will help you understand what the big boys are doing, and will show you when to exit and when to stay away from the market. I can even give you a quick example of that. Okay, I had my resistance line here. I saw it break my resistance line and tested a bit. I saw it do this, and it created a new level up here, and it came down, tested here. Then I knew this my line was respected. Came and it did all this. Every candle here formed every 4 hours. So, and it came and did all this. Mind you, it respected the zone here. So, as I saw the retest here, I waited for a confirmation. What was my confirmation? Let me zoom in. What was my confirmation? I waited for a confirmation. That confirmation was very easy. Hold on, guys. At this point here, I knew the banks were trying to sell. At this point that the market didn't go up very well, I knew the market, we were trying to sell the market at this point. So I waited for the sale to be confirmed. Here it was confirmed and there was a test here. And then a full-blown down candle. I should have entered my trade here, but I didn't catch that move, thank God. So there was more moves, there were more moves and more moves. And then when I saw this candle, with this doji here, I saw this doji, we'll talk about doji in the class. When I saw this doji here, I knew there was an indecision. And that indecision was to tell us that we are not going up because we had dojis more often. See a doji here, you know, there are chances that I may not go up. See this one looking like a doji too, you know. So that was where I waited for the railway candle to form, the railway track, and that means a bullish and a red and a bearish candle. And then I waited for the next candle to form, and I entered just after the entry of the candle, the opening of the candle, and I entered my trade. I waited patiently for it. I caught it and I made my money from this trade. If you are rushing to make money, it is going to. So I knew what the big boys were doing. I knew that at this point, the banks were only trying to establish something. And that is where we have a ranging market. So as it broke out of the range, it tested the ranging market. And then we added it to range again and the fall. So now this fall will test, and we are expecting another breakdown, a full drop. So if we don't see that full drop, then we know that it might want to change sentiment and move back up. But we wait for what the market wants to do. So let's go back to candlesticks. I don't want to, guys, because this one is still a little bit shaky. Okay, Japanese candlesticks are formed using the open, high, low, and close of the OHLC. You will see so many talk about OHLC, the open, high, low, and close. Now, for every candle you see, there is an upper shadow, the real body, and the lower shadow. Now, I want to show you guys something. This is a candle going up, okay? This is a candle up. This is a candle going up. When you have a green candle, this is a green candle according to their book. The opening of the candle is below, and then the candle moves up and comes down and up and closes here. That is why we have a close. This is the close of the candle. So in between these points, from the beginning of the week, the lower shadow to the upper shadow, when the new candle was formed, no matter the time frame, when the new candle was formed, there was opening here, and then the candle, there was a movement. The movement came down below. The movement went up to the upper shadow part. But when the market closed and opened a new candle, it closed here. That is the body now. Now the candle opened here and closed here. But within that time of opening and closing here, it moved to this lower part. It moved to this higher part, and then it came here. So it is the opposite for the red candle. The red candle is a sign that the market is going down. So imagine the market down and it opens a new candle here. It wants like it wants to go up, comes down, does like it wants to go down very well, reaches here, and then comes here, and then the end of that time frame reach, and then it closes here. Let's go and take a look at the two candles in the market. Thank God I have a railway here, so I'm just going to use this railway to define what I'm looking for. Okay, good. So this is the candle I'm going to use to justify what I'm looking for. Let me quickly take these ones out and stop living in past glory. I'm on this trade and it has gone. Okay, so we have two candles here that we can use as, then we'll use. These two candles here look exactly like what they showed us just now in the book. Looks exactly like what was shown in the book. Now, being very clear to see, you can see that the candle as it was going up, it opened here. It opened where the green started from below. Did that acknowledge to drop, okay, and then it went up to the top and closed at this point. Now it opened on the new candle, went up, came down, and closed almost at the same. So both of them opened at the same spot, opened and closed almost at the same spot. The two candles. Now, when you see a candle like Doji, this Doji now, this one here, this Doji here, this where my crossbar is, where my cross is. This Doji here, let me see if I have annotation. Annotate, yeah. Let me see if I have annotate. So I'll just draw. I'm just going to draw. This candle right here, it's a Doji. Now that Doji opened at the same spot, went up, down, and closed still at the same spot. That is a Doji. We have so many of these candles, okay? We have so many of these candles. Take a look at this long one now. This is a sign that the candle moved way down below. And what do we call all these extra lines? We call them shadows or wicks. Are you with me, guys? We call them shadows or wick. Call them shadows or wick. Candle wicks, candle shadows. Okay. So we are just going to go back to our book and continue. So this thing doesn't want to leave my screen. Clear all drawings. Okay. Oh boy. Clear all drawings. So back to the mouse and we move. So let's read what they have to say there. I know some of us already understand. If the close is up, we can say that the candlestick is bullish, which means that the market is rising in the period of time. Bullish candlesticks are always displayed as white candlesticks or green, please. The most trading platform use white color to refer to bullish candlesticks, but the color doesn't matter. You can use whatever color you want. If you download MT4 now, MT4 will use to represent bullish and black to represent bearish. Now you can write this one down if you are watching this video right now. Bullish means a candle going up. So an uptrend, bullish, buy, long, they mean the same thing. Uptrend is when the market is going up in general. Bullish, green candle, buy, moving up, long moving up. And we have bearish, okay, downtrend, sell, and short. Those four, those terminologies, note them, because people use them a lot in forex trading, and you don't want to be left out when people are talking about those terminologies and you don't know what they mean. Let's move on. If the open, you can see that the candlestick is bearish, which indicates that the market is falling in this session. Bearish candles are always displayed as black candles, but this is not a rule. Color, that's what they mean. Okay, you can find different colors. Okay, let's forget colors. The thin lines poking above and below the body are called shadows. The top of the upper shadow is the eye. The bottom of the lower shadow is the low. Candlesticks are different body sizes. Long body size and short body size. Let's have a look. Look at body size here. See another body size here. This is a short body size and a long body size. This is a typical example of how some candles look like. And I can show you like I showed you here. Look at this very candle here. This very candle that my crossbar is over. You realize that that candle has a short body and long wick. Even like the doji too has a long wick and a short body. Look at this other doji here. Let me show you the other doji here. A long body and a short wick. This doji right here on 6th of October 2020. Okay guys, let's move on. We don't have much time on our hands. We'll finish this video in 30 minutes. Long bodies refer to strong buying or selling pressure. If there is a candlestick in which the close is open, the close is above the open with a long body, this indicates that the buyers are stronger and they are taking control of the market during this period of time. Conversely, if there's a bearish candlestick in which the open is above the close of the body, which means that the selling pressure controls the market during the closing frame. What they are saying there is simple. If you have a candle, a long green candle or a long white candle, that body is pushing higher, well, that is a sign that more buying pressure. You can buy that market if you have good confirmation. If you have good confirmation, you can buy that market. Likewise, the bearish candle. Simple examples are like this very long red candle you are looking at here. There was a bearing pressure here, a bearish pressure here, a selling pressure, a bearish selling pressure. Although the sell did not happen immediately, but we were able to experience a lot of move before we now finally got the sell here. Before we finally got the sell here. Okay, there was this had occurred right from this top part here. The selling pressure occurred right from this point. That's where the selling pressure occurred from, right from this point here. And take a look. As soon as there was a movement, look at the strong selling pressure here, and then another strong selling pressure. Okay, selling pressure before we now finally got the final move where this arrow is right here. Okay, that was because the candle showed it. We saw it in the candle. That is where I'm getting my pressure from. Look at this. Look at the green candles at the beginning of the screen on my left. Look at the green candles. We have bullish pressures. Lots of long green candles. These long green candles moved up, and then the candle reduced, and then the candle reduced again before we now started having some serious red in between. And look at this red candle here. Let me show you guys something. Look at that red candle I just highlighted. The red candle has a very long shadow at the top. What does that mean? That means the market at top, and because there were no much buyers in the market to buy it again, the candle came down and closed below its starting points. What does that mean to you? The selling pressure started occurring. The bullish and the buyers have lost momentum. There is now a selling pressure coming in. Although the body is short, but the wick, the shadow, is very long. That shadow showed us what is happening. There is a selling pressure. And if you notice from that, after this candle, the market did not pass the top of the shadow again. The top of the shadow, the market kept dropping from that point. And if you want to draw your trend line, it is from that point you start noticing that there is a difference in the market movement. There is a difference in the market. There's a difference in the market movement. I wish I can get here. Can you see that? From that point, there was a difference in the market movement. A drawdown to the downside. So let's move on quickly. We still have a couple of minutes to go. Let's move on quickly. Short and small bodies indicate a little buying or selling activity. Candlesticks, good. Long shadows, long lower bodies, long upper shadow, long lower. When you see a long upper shadow, you know that there is a selling pressure in the market. And when you see long lower shadow, buying pressure in the market. That is just what it's all about. That means you should be looking for, you should not be suspecting that market that it might want to move. Especially when you see this kind of market on an uptrend, like I just showed you here. This is an uptrend here, and then we saw the candle here. What happened? We started seeing that the candle started dropping. The market started dropping. And when you see that kind of candle in a downtrend, look at it here now. A downtrend has happened. The candle has formed here. There are chances that we might get a little bit of bullish pressure. The candle will move it before we'll now see more dropping. But let us watch and wait. So I'm just going to skip that because that one explains that. I'm talking about that for a while. But I'll just read through. If a candlestick has a longer upper shadow, a short lower shadow, this means that buyers flex their muscles and bid price higher. But for one reason or another, sellers came in and drove price back down to end the session back near its open price. If a Japanese candlestick has a long lower shadow and short upper shadow, this means that sellers flashed their washboard abs. Too much stories, just what I just explained. Now, candlestick patterns. For what it is worth, please note all these things. One, the engulfing bar. We have of engulfing bars, the bearish engulfing bar and the bullish engulfing bar. And I'll be showing you these things. This is the bullish engulfing bar. And I will show you these things in the charts. We'll look for it together and I will show you. When you see a bearish engulfing bar is when a bearish engulfing is when there is a red candle after a bullish candle, after a green candle, and the red candle opened and closed to swallow up the green candle. If you look at what we have here, where the red candle opened, the opening price, where the top is at the top, it is higher than where the green candle closed. And look at the closing price way below. It can swallow this one, up, top, and bottom. Nothing will happen. That is an engulfing bar, a bearish engulfing bar. When you see this kind of thing, expect the market to drop. Expect the market to do what? To drop. It is opposite for the other one. When you see this kind of thing, expect the market to drop. I don't know why we are even having more of it in our chart today. Let me look for a bearish engulfing bar here. If we don't have a bearish engulfing bar, then we move and go and look for a bullish engulfing bar. Okay, we don't have a bearish engulfing bar here. Let me look for a bearish engulfing bar, please. This one should have been a bearish engulfing bar. This one we have here should have been a bearish engulfing bar, but I don't want to use it because the closing price of the red candle is the same thing. But yes, this is an engulfing bar. Immediately it happened. What happened? What did we see? Immediately what did we see? The market dropped. Immediately it happened. The market dropped madly, massively, and you would have made a lot of money if you caught this move right here. If you caught a move right here. This is another example here. Look at the shortfall that happened here. This shortfall would have given you good money. Bearish engulfing bar. Bearish engulfing bars. I'm still looking for bearish engulfing bars. Okay, in the absence of a very sweet example, because I'm not seeing a sweet example, although I have shown you one or two, but that being said, that is what it looks like, something like this. It engulfs the other one. English language, engulfs, to swallow up, kind of. So that is what it does. It swallows up what has been there. It swallows up what has been there. So whatever is swallowing up what has been there, what does that mean? It is bigger than what has been there, and you should look towards that one. Exactly. So, and a bearish engulfing bar is the opposite of a bullish engulfing bar. A bearish engulfing bar is the opposite of bearish. This is a bearish. A long red candle after a small green candle. This is how a bearish engulfing bar pattern looks like on your chart. This candlestick pattern gives us valuable information about bulls and bears in the market. There should be more. In the case of the bearish engulfing bar, pattern tells us that the sellers are in control of the market. When this pattern occurs at the end of an uptrend, this indicates that buyers are engulfed by sellers, and which signals a reversal. See the example below. Now, we notice there was an uptrend. See green candles, I mean the white candles going up. And then there was a small white candle and a very long red candle. Very long red candle. And what did we see from there? The market dropped. Okay. The market did what? The market dropped immediately. And so when you see something like that, you will just go and enter your sell. When you see a market running like that, like this kind of this type now, when you see something like this, you know that the market is about to drop. Just enter your sell somewhere here, like 2 away from the green candle, and let it ride. No matter what you get, money is money. $50, $20, $30 from that trade, you take it in and you go and rest. Okay, so that is what happens. We'll still learn that more in analysis. Then when we're analyzing, we'll talk about as we are analyzing the market, you will hear me talk more about these things. You will hear me talk more about these candle bars because we'll be seeing them in the market. So I'll be talking more about them. So let's look at, as you can see, when this price action occurs, uptrend, we can anticipate a trend reversal because buyers are not still in control of the market and sellers are trying to push the market down. Sellers are trying to push the market down. You can't trade any bearish candlestick pattern you find on your chart. You will need other technical tools to confirm your entries, which I will be telling you of. I'll be telling you. We'll look into details in the next chapters. Right now, I just want to open your charts and try to identify any bearish candlestick pattern that you find. I have shown you one. The bullish engulfing bar consists of 2 candlesticks. The first one is a small body. And the second one is the engulfing candle. Sorry for that delay. We can look at it. There was a downtrend, and then we saw this. So let us go and look for a downtrend. Let's go and look for a downtrend and see whether we can catch an engulfing bar there. I'm seeing one, but I don't know if we can use that one. It doesn't look too valid. See it here. After this downtrend, immediately after this downtrend, we saw this. There was still a bullish pressure. We had this Dragonfly Doji, and then we saw this. This is not an engulfing bar. But then I'm looking at this. What happened here? Something happened here. Look at it. There was a bullish candle here, and then there was a bearish candle here, sorry, and then a bullish candle, a red candle, and then a green candle. The green candle swallowed up the red candle, and then we had it push to the top. That was what happened there. Let us look for more downtrends. I think I will go to DXY. DXY has been falling like crazy lately. Has been falling like crazy. So I think I'll go to DXY. But let me just check. See a downtrend here. And then we saw this. This is engulfing. Although this one is not that. This is not too small. It did not engulf it though. Not engulf it. It did not engulf it. I hope you understand what I mean, because when you see these things form in the market, you will know what to do. You will know what to do. That is my aim. I want you to know what to do when you see these things form in the market. I want you to know what to do when you see things form in the market. That is what an engulfing bar is. There is a downtrend pushing to the downside, and then the uptrend wants to start. It swallows up the candle. Look at this one here. Look at this one here. Something happened, and we had a small push. You can make money from here. How many pips would that have been if you cut this move from here? You have cut at least 30 pips. And if you use 1 standard lot to run these 30 pips, you would have made at least $320. And if you use 0.1, you would have made $32. That is how it works. Just this small move. Just this small move, okay? Just this small move. 30 pips from this move, you would have done $300 with 1 standard lot size. Just like that. That's about 100K from this small move. And you know how many moves are in the market in a day? So basically, that is that about the engulfing bars. You can write that down. The bullish engulfing bar pattern tells us that the market is no longer under control of the sellers. Okay, so you see it. And you see it. There was a push to the downside, and then we saw the engulfing bar. Can you see the engulfing bar? Oh, that was an engulfing bar that we saw there the other time. This is it, and then we had a push to the upside. I think that is explanatory enough. You can still go back and read more about it. Let's move to the next candle, the Doji. This is my favorite candle, the Doji. See it? Opening price, closing price at the same spot. The lowest price with the shadow, the highest price with the shadow. At the same spot, let us read what they have to say about it. Doji is one of the most important Japanese candlestick patterns. When these candlesticks form, it tells us that the market opens and closes at the same price, which means that there is equality and between buyers and sellers. There is no one in control of the market. See the example, like we just saw just now. And then they went further to say, as you can see, the opening price is the same as the closing price. This signal means that the market didn't decide which direction to take. When this pattern occurs in an option that trend, this indicates that the market is likely to reverse. Reversal, I told you earlier. Look at an uptrend coming up, and then we had a doji. What happened immediately? There was a downtrend. Most of the time when you see a doji, something wants to happen, a change. Look at this. It was going up, and then we had a doji, and then went down. We had a little push up, and then we had a doji, went down. When you see a doji, expect something to happen. If we had a doji here, we would have been expecting the fact that it will move up. But what I'm having here now is someone like a doji or like a hammer. So we might have a little push to the upside before a continuation of our downtrend, which is a typical movement in the trend line formation, which I'm still going to show my premium students, those of you here. That's what a doji does. The chart above shows how the market changed direction after the formation. The market was trending up. That means that the buyers were in control. When the market is moving up, I told you that's the buy. The buyers are in control. The formation of doji candles indicate that the buyers are unable to keep price higher, and the seller push price back to the opening price. Like people bought the price at 300 naira and wanted to take it up to 400, but the seller said no, we are 250. But while they were fighting, it finished at 300. What does that tell you? The new people coming to the market have more pressure than those that have been in the market. Meanwhile, those that have been in the market should have more pressure than those that are just coming in. But imagine coming in, pushing back the price to the amount that those that has been there took the price to. You entered price at 300 and took it to 400, and those that were in that market said, no, we are taking it back to where you started from. That's a power of reversal. That's one power of reversal. Trending up, that means, okay, the price formation, okay. Remember always that a doji indicates equality and indecision in the market. You will often find it during periods of resting after big moves, higher or lower. When it is found at the bottom or at the top of a trend, it is considered as a sign that a prior trend is losing strength. So if you're already riding that trend, it's time to can also be used as an entry signal if it is combined with other technical analysis. We'll talk more about that. Now, the Dragonfly Doji. Guys, look at it. Opening price and the closing price was at the top. See, when you see a Dragonfly Doji, just know that there is not market than start buying. Yes, start buying that market. Because a Dragonfly Doji mostly appears after a downtrend. A Dragonfly Doji mostly appears after a downtrend. That is a bullish candlestick pattern, which is from when the open, high, and close are same about the same and same about the same. What characterizes the Dragonfly Doji is the long lower tail that shows that a shadow, long lower shadow that shows that the resistance of buyers and their attempt to push up. You see the buyers and their attempt to do what? To push the market up. When you see a Dragonfly Doji, immediately go and start finding a way to buy that market. Wait for the next candle to form to confirm your sentiment of a buy and push it up. It mostly appears after a downtrend. The illustration above shows us a perfect Dragonfly Doji. The long lower tail suggests that the forces of supply and demand are nearing a balance and that the direction of the trend may be nearing a major turning point. See the example below that indicates a bullish reversal signal created by a Dragonfly Doji. Okay, so there was a downtrend, and then we had a Dragonfly Doji. And what happened then? We saw a bullish move. A bullish move. There was a bearish move. The Dragonfly Doji formed, and then there was a bullish move. There was a what? There was a bullish move. There was a bullish move. Let's check that in the chart. I am looking at this one as a Dragonfly. Oh, this market is pushing to the downside. Wow, nice. Wow, it's nice, nice. It's not done doing its pullback. So, this is a Dragonfly Doji kind of, but not really. Not really. It's very difficult to see Dragonfly Doji actually. It's very difficult to find one. But when you find one, be rest assured that you are in for some money. I must confess to you, when you find one, be sure that you are in for some money. Because your next candle will confirm what the market wants to do. When you see those kind of candles, your next candle is confirming what is going to happen in the market. Your next candle is going to confirm what is going to happen in that market. So we've talked about the Doji that looks like a cross. I'll talk about the Dragonfly Doji that looks like a T. Okay, that looks like a T. In the chart above, the market was testing the previous that caused a strong reaction from this area. Okay, but I always say you can't trade candlesticks. My premium students will have this one, so you can read through. Gravestone Doji. Let me just show you guys a picture. The opposite. The Dragonfly Doji is a T, and the other one is what do we call this one? I don't know. An inverse T. When you see this one, know that you're going in for what? A sell. I'm about to end this video. I don't want to get too long again. It's just the opposite. Dragonfly Doji, Gravestone Doji. Dragonfly Doji, Gravestone Doji. You may not know the names offhand, but when you see the candles, you're able to know what they want to do next. Okay, when you see this, you know that yes, there is a selling pressure. This normally occurs, the Dragonfly Doji occurs after a downtrend. You see it will appear, you know that there is an uptrend coming up. This one appears after an uptrend. After an uptrend, you see this kind of candle formation, the new candle forms. Know that the buyers have lost momentum. That is why we have a lot of shadows there. And then the sellers want to take over the market. When you see a Dragonfly Doji, you can read through all that. Let us have a look. Can you see this? There was a push to the upside, and then saw the Gravestone Doji. The opening price and the closing price almost at the same spot. And then we saw the push right straight up. And then let's talk about the next one quickly. The Morning Star. These are the ones that kind of confuse a lot of people sometimes. A bearish candle, then there is a smaller candle in between, which could be either be bearish or bullish, and then a full bullish candle. The Morning Star pattern is considered as a bullish reversal pattern. Morning Star Now, this is how you can easily crown it. There is morning star and there is evening star. Morning sun, rise, right? So we'll assume the candles for morning star are below. Okay, while evening, the sun sets. So the sun goes up and starts setting from the top. So evening, we'll say the sun is up. Because in the evening star, this middle candle here is on top, showing a reversal to the bearish. This will be in the evening star. This will be a bullish candle going up, and then a bullish or a bearish whatever candle up here, and then there will be a bearish movement to the downside. Okay, while this morning star is like this. Now there is a downtrend coming, and then we have this candle, and then we have a small bullish or bearish candle, and we'll definitely find it on a UD card. Definitely find it here. Let me show you, because it is always forming. It is always what? Forming. It is always forming. The trend is not that slick, so it is always forming. Always forming. We can check this one out. You see that this is like the evening star. This is like the evening star. Bearish candle. This is an uptrend coming. This is my uptrend line going up here. This is a bullish candle. This is a candle, a bullish candle here, then a red candle, a bearish candle. This is an evening star. This is an evening star on top here. So if it's a downtrend and this thing happened like this, we would have said it's a morning star. It's a morning star. And because I'm using the 4 hours time frame, if I go to the lower time frame, I should find these things more. There. So basically that is what it is. Let me reduce it to a lower time frame. Let me take it to 1 hour. Take it to 1 hour. Okay, so we have trend coming up here, and then we had this bullish bearish candle. We had this small one, and then these two small ones, then this long one here. Basically, before we finally got the rise. So this is a W pattern. This is a W pattern. So I'm expecting there should be a rise here. There was a break. It broke. Yeah. So that is what it's about. Let us see it here again. See it. There was a bullish candle here. There was a bearish candle here. I saw it somewhere just now. Yeah, there's a bearish candle, and then we had the doji form and this one form. This is our morning star here. Get used to this thing. You don't want to enter a trade and the trade goes against you. Or wrong. You don't want to do that. You cannot be losing money. We are here to make money, so we cannot be losing money. So that is about the morning star. Look at it right here. There was a big bearish candle, a small bullish candle, which could be seen like a hammer or almost like a doji, and then the bullish candle, a bearish, small bullish candle, and a full bullish candle. Then there was a push to the upside. That is a morning star. Evening star pattern, the direct opposite. I told you, you have to, when you see a bullish, then you see a small candle and then a bearish candle, showing you that the pattern has changed. If you want to enter this trade now, you wait for the next candle to form and you enter your trade, only if it is being pushed by the news. Exactly. An uptrend, the pattern forms here, and then a downtrend. So let's see the next candlestick formed. The hammer pin bar. This one is easy to know. When you say a hammer, what does it tell you? A hammer at the top. This is like a doji, but it has a better body. Opening and the closing price are not at the same spot. The opening and the closing price are not at the same spot. When you see it, boom, you know that you are going in for a buy. Let's see what they wrote. The hammer is a reversal candlestick when it occurs at the bottom of a downtrend. When it occurs at the bottom of a downtrend, push for a buy. I know somebody will be asking in his mind, how do you know the downtrend has stopped? How do you know the downtrend? That we'll treat later. These are the candlesticks that you use to know that the downtrend has ended. Another thing is you could draw a support zone. Drawing a support zone, you will know that when your candle reaches that support zone and this kind of things form, this kind of candles, doji, dragonfly, or this hammerhead forms, so that there is a reversal, especially when it's on the support zone. The candles forms when sellers push the price lower after the open and they get rejected by buyers, so the market closes higher than the price. Can you see that? Can you see that? Can you see that? Hammerhead. Can you see that? Can you see that? And then push the up. I'm coming. The hammer pin bar. I'm coming now. We'll see the opposite here. The shooting star. The opposite of it. It closes after an uptrend. You see this, and then you see a downtrend. And what happens? And what happens? And what happens there? Immediately. There's a downtrend immediately. Let us look at the example here. Boom. Can you see this? Can you see this? I have shown you this example severally. This is an uptrend. We have it here. Look at the shooting star here, and then we saw a downtrend show up immediately. Okay, we saw up immediately. Now you may see these candles show up at intervals, but be careful. Be careful. Now, most of all these candles are just forming randomly because of the way prices are being moved. You have to be careful. Make sure that your positions are shown and you are not in a hurry to make money. Don't be in a hurry to make money. Don't borrow money to trade forex. You might lose it. Okay? You might lose it. So that is all about candlesticks. That is all about candlesticks. All these Arami patterns are things you can go and read on your own, because if you learn all this one, you trust me, because all these patterns form a lot in the market. They form a lot. Back in the days when there were no more traders, you may not see this kind of overforming. When the patterns form, you know that they are respecting price. But when these kind of patterns form now, they are not really respecting price. They are just forming because so many people are doing so many activities on the chart board. But you get to read about them. The Arami pattern, you can write them down. The Arami bearish pattern. This is a bullish candle and then a bearish candle and then a bullish candle. What happens after the Arami pattern? As you see, the smaller body is totally covered by the previous mother candle. We call it a pregnant candle. Can you see the Arami? Can you see the Arami? It's a pregnant, get belly for front. And then the other one. So when we see this candle, we know that something else is about to happen. For me, when I see the candle, I always wait for something else to happen, the next candle to form. When we have this Arami pattern here, a mother, very long one, and then a baby. You know, the market wants to do something different. I wait for the next candle to form. In short, most times I don't even take my trade when I see this kind of long candle, because most of these long candles are being determined by news. So you don't know what the news wants to do after that. So you have to wait. That's why I don't really like teaching people about Aramis, so you don't get mixed up. Mostly push the candle to make it look like Arami. And then that happens. So top and bottom. Forget this one. I call this one my railways. When you see tweezers like this, you see a bearish candle and then a bullish candle, we know that it is moving up. When you see a bullish then a bearish, and it is moving down. It's that easy. It's that easy. I think we should stop here for now. Exactly. The market came down and then we saw this side by side. What happened? It moved up. I showed you something similar in the chart here on my 4-hour candle, on my 4-hour chart. Look at something. Look at this. The tweezers here. You see it. There was a red one and a green one, and the green one forced the market push to the upside. So I think we can stop here for now. These are different candle patterns forming in the market and making the market move. You should do the same exercise. Go to a chart, on tradingview.com and look for patterns and identify them. Take a whole week to identify patterns. Very important. Take a whole week to identify patterns, and you are on the right path to success. See you guys on the next video. Catch you guys later. Okay.